a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
It's time now to get the updated spoken word on the stock market from our chief equity strategist, John Blank, who joins me via Skype from the West Coast. John, what is your message these days regarding the stock market?
Terry, the message I want to make today is that the timing of the first Fed rate hike that showed up as the big cause célèbre in September, in the September FOMC meetings, is less important than the market's call on the number of rate hikes that the Fed's going to give us over the next 2 years. If you look at the 10-year U.S. Treasury rate, Terry, we went from 2.25% to 2.0%. We lost 25 basis points, which effectively is a rate hike by the Federal Reserve. So now, at 2% in the 10-year, what the market's telling you is that with 1.5% inflation, the only rate hikes we're going to get over 2 years to 2018 is 50 basis points in rising rate hikes from the Federal Reserve. So the first one might be in March or April, it might be in June, and we might not get another one, Terry, for 6 months after that. So it's a very, 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 very flat rate structure that's driving the stock markets up right now. It's that weakness that's driving down the number of rate hikes, and that's giving the liquidity boost to the stock market.
I'm actually hearing that there is talk running around the trading floors about QE4. Are you hearing the same thing?
Yeah, the QE4 is an idea that, you know, the Fed will be data dependent, and if the data gets worse, Terry, really bad, we get to GDP growth that's negative, we start to see job losses, then QE4 can come back. But it's a very low probability event. What's really a high probability event is the need for writing publications on federal quantitative easing. But the actuality of that happening is probably at the 10% level right now.
All right, we're coming up to peak time for the QE or the Q3 reporting season for earnings. Are third quarter earnings reports critical for stocks to move higher in the fourth quarter?
Absolutely, Terry. They're not as critical as the Fed, though. I mean, the truth is right now the Federal Reserve's really accommodative stance going forward is what's driving the market. But behind that is third quarter earnings, and we are seeing flat revenues. There's minus 0.3% growth in revenues out of 4% rise in earnings so far out of the 20% of companies that have reported. That's telling you that basically companies are massaging their earnings, and they're using stock buybacks and accounting gimmicks because the revenue growth is not showing up. And this is telling us the same thing the Fed knows, is there's no growth out there to chase. So that's what's keeping the market alive. But as far as equity investors go, that's kind of a sweet spot because you don't have any inflation, you don't have any risk of the bond market getting in the way, and you have a ramp up for valuations now after the correction.
So bottom line, what does the market need to move higher?
The market needs to get through Q3 earnings without having a big blow up or some kind of consensus getting changed that moves the Fed rate hikes back into play. So in fact, we've got to kind of skate through at consensus on what happens in the market to earnings, and then we're going to see that the market's going to get bid up. It's really looking for a grenade to go off. If it doesn't go off, the market can go higher, Terry.
All right, as far as sectors go, you're saying healthcare and consumer discretionary are going to lead the way here over the near term. Utilities could stay strong to December. Give me some examples of stocks you're looking at.
Yeah, ticker ACHE. This is Acadia Healthcare. They've sold off from about $80 to $60, Terry. They've been beating on earnings every quarter going back 5 quarters. This is inpatient behavioral and chemical dependency healthcare. So this is your recovering alcoholic and drug addict and worries about mental health type clinic. And this is getting coverage under Obamacare, and it's growing rapidly across the nation. So this is a great play now. The drug and healthcare sector is very highly rated. This company is still a number 1, 2 ranked stock this morning. And you've got the valuations in place for the first time on this stock in a long time to bid it up.
All right, and this morning that you referred to as October the 19th. Then there's another company, Aaron's.
Right, Aaron's, AAN, ticker AAN. This is a sleeper stock. It's been going up very strongly for basically since the middle of 14. What it does is they lease HDTVs and furniture and whatnot for your house, appliances. they're a leasing company. So if you don't want to buy a 65-inch HDTV or a 4K TV, you can go to them and just do a rental month to month. And this business is growing. I'm not sure why. I don't do it myself, but it's growing nationally. And the price to valuation ratios are staying below 2. So it's beating on earnings, Terry, sometimes as much as 30% in the last 2 quarters. And going back 5 quarters, it's beaten every time. So you got to look at the stock. The only worry I have about that stock is if it misses, if the story doesn't get as strong as the market thinks. There was a big short on this stock last year that knocked $10 a share off it overnight, and you got to worry about that with Aaron's.
And finally, Connecticut Water.
Connecticut Water is your typical defensive stock. Again, you got to like anything that's defensive in this market. It's still not an entirely growth-centric market, and you're getting a bid out of the earnings on this stock as we enter the summer season, and it's just a kind of a nice sleeper stock to think about. Connecticut Water and basically supplying water in that part of the country.
All right, John, thanks. There you have it. The spoken word updated on the market and a couple of interesting sectors you may want to pay attention to. With John, I'm Terry Ruffalo.